Afternoon, Outliers. How y'all doing? I'm still a little under the weather, better than I was this morning and last. Oh my gosh, like yesterday afternoon, I was toast. I think I went to bed at like 5:30. I told my wife, I was like, I'm taking the night off. Enjoy the boys. I am done. So yeah, but we're making it through. Good to see everyone. Jean-Louis here and others. I want to jump into today's video talking about different types of stock. Now, this is something like I literally do not pay attention to at all. At all. The common stock versus preferred stock. So today's video is common stocks versus preferred stocks, similarities and differences. Hey, Randy. Hey, Mikey Mike. This might be useful to you as a new trader. So let's jump into this.
Welcome to LumoVest. In this video, we're going to talk about common stocks versus preferred stocks and how investors make money from these two securities. When people talk about stocks, on TV or on the internet, they're usually referring to common stocks. That's what all companies have, and generally what people invest in when they buy stocks. But a small portion of companies will also have preferred stocks in addition to common stocks. These preferred stocks are publicly traded on the stock market, just like common stocks. So today,
I think Google has that. One is Goog. The other is Google. I don't know the difference. Hang on. Let's Google this up. Or let's get ChatGPT to tell us real quick. What's the difference between Goog and Google in the stock market? Let's see how smart ChatGPT is. Oh, Class A is Google and Class C is Goog. What is the difference? Google, Class A, shareholders, 1 vote per share, allowing them to participate in corporate governance, blah, blah, blah. Class C, do not provide any voting rights. Well, look at that. I learned something. Hey, Peter. Randy, 1 voting rights. Look at that. You knew about it more than I did. Wes, hey, I don't log into Twitter very much. Any Twitter posts you see are done by our team, mainly Simon handling that. I just saw your tweets from the election. So yeah, I'm sorry I'm a month late on that. But yeah, I agree. Everything you said, I agree with.
we're going to learn about the similarities and differences between common stocks and preferred stocks. By the end of this video, you would have developed a really solid conceptual understanding of the two types of stocks available on the stock market. Let's start with similarities. Both common stocks and preferred stocks are stocks in companies. When we invest in them, we're really investing in the underlying companies.
Right.
Both entitle you to claim on the company's assets and profits, meaning the money that the company makes from selling its products and services is given to both common stockholders and preferred stockholders. So, how are they different? The key differences between the two types of stocks is mainly in terms of the investment return and risk profile. Said differently, the key differences between the two is how the investors can profit from the investment and the level of risk investors have to bear. Common stocks generally have higher return potential than preferred stocks. That's because whereas common stockholders profit from both capital gains and dividends, preferred stockholders profit mainly from dividends. If you don't understand the
Oh. Well, preferred stockholders mainly profit from dividends. Does that not mean that does that mean that their stock doesn't change value like a regular stock on the market? Michael, good to see you.
distinction between capital gains and dividends, check out our other video explaining this concept. Preferred stock prices don't move much. They're usually contained in a tight band, so most of the investment returns will come from dividends as opposed to capital gains. This is huge. This has major impact on returns. Most of the profits in the stock market come from increases in stock prices. There are stocks whose prices can...
Right, and that was my question, because most of everything that we talk about are the capital gains associated with common stocks. Okay, I didn't realize that preferred stocks have a tight range in prices, is at least how he described it.
Increase by 50 or 100%. But dividends may only pay 2 to 6%. Once you remove the ability to profit from stock price increases, the returns profile for stocks is much lower, and that's essentially what preferred stocks is doing. So investors in preferred stocks really don't get the same upside potential as the investors in common stocks. That said, while the preferred stocks don't have as much upside potential, They also have much lower risk. Remember, stock prices can go both ways. It can go up, but it can also go down. The common stockholders bear a much greater risk in this regard than the preferred stockholders, because the preferred stock prices don't move much. So the preferred stocks have lower profit potential, but also lower risk. Another reason why preferred stocks have a lower risk profile is because companies have to prioritize giving the money to the preferred stockholders that they're entitled to every period, before they can give money to the common stockholders. Whatever remains can be paid to the common stockholders. Said differently, they have preferred status over common stockholders when it comes to the claim on the company's profits and assets. That's why they're called preferred. Let's illustrate with an example. Say a company only has
Randy jumps in. Preferred stocks are less volatile. That's what we're learning here for today, for sure. They are superior in the capital structure between bonds and common stocks. Okay. Oh, I get what you're saying. So if I were an investor and I would pick a preferred stock to invest in a company versus buying a bond from that company, okay, I can get on with that. That makes sense.
$100 million of cash to pay dividends, and say the preferred shareholders are entitled to $100 million in dividend payments.
Mikey Mike asked a good question. Can anyone trade preferred stocks? I don't know the answer to that.
In this,
Let's ask ChatGPT. I already closed. Oh, no. Okay. Can anyone trade? It's like a hybrid between a common stock and a bond. Who can trade preferred stocks? Retail investors, so you and I. Institutional investors. Important considerations. Minimum investment, dividend taxes, research and due diligence, etc. But to answer Mikey's question, yeah, anyone can. Bjorn, good to see you.
case, all of it will have to be paid to the preferred shareholders first, leaving nothing left for the common shareholders. In this situation, common shareholders won't receive any dividend payments. But if the company has $500 million of cash to pay dividends, preferred shareholders will only get their $100 million, and the remaining $400 million will all go to the common shareholders. The takeaway here is that preferred shareholders have more certainty of their investment returns because of this preferential treatment over common shareholders. This higher claim for assets and profits further limits the downside risk for preferred stocks. Another major difference between common stocks and preferred stocks is on voting. Common stocks usually entitle their holders to vote on corporate matters. Preferred stocks, on the other hand, is typically structured without the ability to vote.
Oh.
So whereas common stockholders can voice their opinion in elections by casting votes, preferred stockholders can't. So these are the distinctions between common stocks and preferred stocks. Now we'd love to hear from you. Do you guys lean towards investing in common stocks or preferred?
Well, look at that. I feel like I learned something today. And actually, I'm excited about these videos because I know for a fact that there is still a million more things for me to learn in the market. Even though I've been trading it since 2009, there's still lots to learn. And I just learned some stuff today. So that was pretty cool. Sebastian made it. Randy says, in the case of bankruptcy, common stocks are the first to not be paid out, then preferred, then bonds, then commercial paper. Oh. So, Randy, clearly you're an expert on the subject. Is there a time where you would realistically, not just in theory, but in realistically speaking, that you would buy a preferred stock versus a common stock? And what we normally trade, of course, is common stock. So specifically, Randy, is there a time where you would pick the preferred over the common? I'm actually very curious. Hey, Donna, good to see you. And while Randy types out that answer, like I say, not feeling awesome today, but I'm doing my best. Let's jump into our market analysis. I had to mute myself while I coughed. Welcome to the Outlier Trading Room. This is smart trading made simple. This is where we save time, make money, and start winning with less risk together as a team. And for those of you who don't know me, my name is Christopher Ewell. I've twice been awarded Top 100 People in Finance and been successfully trading since 2009. I'm a partner with Outlier, and this is my style of trading using the Outlier data, called the Golden Ticket Trading Strategy. Speaking of Outlier data, Mahesh was giving me a preview of the next release that was coming out today. And let me jump into, I don't have access to that yet, but I can give you an eyeball or approximation of what it looked like. Let this load up here on the SPY. All right, so the oscillator is going to go away because, as they mentioned in the Discord, they're finding that the oscillator is returning nearly identical data points to the heat map, and we're already using the heat map, so we're going to continue to keep that. But couple things we're going to see changed is over down here. This is the market breadth, the number of stocks that are showing the uptrend and downtrend overlays. What do I mean by that? That's these overlays back here, right? They're either going to be white, green, or red. And this shows how many stocks are white, green, or red in that sector. So in the S&P 500, on this particular day, October 15th, 279 were in uptrends, 31 were in downtrends, and everybody else was in white, right? So that is actually going to move up into the market breadth. Right, so this is going to move up into this chart. Now, you're still going to be able to see the market breadth as a line, but it's going to have a background of this here. So I had a preview of that today. It looked like you could totally read it, so I'm not worried about that, but that could lead to some really interesting data points that we're going to see. And then there's going to be a new chart. So this chart goes away. This chart gets moved into this chart, and then a new chart is going to come down here. And this one, if you look over here at the, what is this called? Constituent map. This shows how many companies, in fact, I learned something today too. This shows how many companies are in the greed. I'm sorry, in the greed, how many companies are in the fear. And then what I learned today was how high it is on this scale is how much greed it has. Like G40 would be way up at the top, right? And so in the S&P 500, you've got some that are up at G40 and you've got some at like R37. I didn't know that until today. I just thought that was a number, number of stocks moving that number up. But yeah, the higher it is, the deeper in the greed or the fear that is. So this is one of Mark's favorite tools. It's going to be moved down here. And he likes to look at it on a daily basis. He said it's actually really painful because, you know, let's say you move it to this date here, you got to wait for it to load. Then you go the next day, then you got to wait for it to load. So this should be an interesting data point that's going to be moved down here. And it's going to look a lot like this as it is. So a few new updates coming through here. Randy replied, I've had preferred stocks, but not that many. While I was a stockbroker, I managed my clients that loved preferred stocks, and I had many of them in our portfolio. As you said, common stocks are much more common. Yeah, for sure. By the way, I just got to say, if Randy, a former stockbroker, is hanging out with us, we must be doing something right. So real quick, how does Outlier work? It's a 4-step process. Outlier monitors how investors are reacting to changing market conditions, news, price movements, and the economy. Outlier determines if investors are acting irrationally, fearful, or greedy, and by how much. Outlier gives buy and sell signals when those irrational behaviors reach an extreme. Number 4, allowing you to get into the stock before the outlier move happens. So let's skip over to today's member highlight. All right, so jumping in the Discord here. Not Alex, Peter. Peter came to town and let everybody know this really cool project he's been working on. I'm gonna do a quick preview of this. Like I told Peter, I sent this over to Mark and Mahesh because I was really impressed with some of the stuff that, he's put together. Let me see. Like he's got his trade journal here. What really impressed me was he was able to automate pulling the data out of Outlier without the API. Oh yeah, it's doing it right here. And I know that the API is something that Mahesh is currently working on. So it's going to be even better. But I was super stoked to see how Peter did that. So if you guys have some time, go check out Peter's post and his full video where he outlines it all. Peter, you are a rock star, my dude. A gold star for you, as I like to tell my children whenever they do a great job. You did awesome on that. So be sure to share your stories in the Discord and tell everybody you know about Outlier. And do me a favor, hit the like button. That tells YouTube to tell everybody as well, right? And it costs you nothing, right? It's free. Just hit that like button for me. All right, I do want to take a look at the market. You're welcome. So is preferred a high probability of dividends steadily coming in? I think preferred would be more like a bond, Mikey Mike, where let's say you invest $1 million into something and then you're guaranteed a coupon rate. Let's say that coupon rate's 5%. So you can count on that coupon rate over time. And then you also get your $1 million back at maturity. Randy, correct me if I'm wrong, but I believe that's how I'm interpreting it. Now, I want to see the 10 over the 20, price over the 50 on the market, which we have, but I have big reservations in the market right now. Yes, we're hitting new all-time highs today. That is a very bullish sign. But this really concerns me, very muchly so. So this is a 10-day moving average of the volume of the market, okay? This blue line down here. And hang on, got a call. Okay. As you can see, the market moving average has been pretty flat for a while. I would say since mid-October, it's been pretty flat. But we actually are seeing less and less and less volume in the last several days, even less than we did the week of Thanksgiving, which was the 23rd through 27th. Here, we see less volume today than we did the week of Thanksgiving. Right, these 4 candles here compared to a while. That's really concerning. Why is that concerning? If you remember what I described before Thanksgiving, I said, watch for more volatility. Because if there's less participants in the market, you have to move further to find a buyer or further to find a seller, okay? And that's kind of what we're seeing playing out here in this market moving up the way that it is. Minervini would absolutely lose his mind right now. I haven't talked to him lately about this, but a rising trend on greatly falling volume below even a holiday week's volume, that to me screams red flags. Now, we do have a sell signal on Outlier, right? So you can't see that. So as you know, I wouldn't be trading long. I personally won't be trading long right now, but that reduction in volume is very concerning to me. I don't look at volume all that much, but this stuck out to me because I was just looking at this. I was looking how this was going up, and then I just happened to glance and see this going down. It's not what you want to see. Not at all what you want to see. I'm trying to give you some examples here. Kind of what it looked like in June, right? You can see volume being below average, and then we had a big sell-off. But then again, we saw volume under the average here, and we came back up, and then we sold off again. So I'm definitely not calling a top, but what I am saying is this makes me nervous. Randy, most preferred stocks have a fixed coupon, which means the dividend amount remains the same for the life of the issuance. Okay. I understand. So it is like a bond. That makes sense to me. I guess I never put 2 and 2 together. That it's really just like, if you want to think of it this way, it'd be like if you took out a loan from the company, or the company took out a loan from you, right? They're going to pay you back what the coupon's worth on your preferred stock, and then your price of the asset should stay in a narrow band. Seems like it might have some market fluctuations. It doesn't sound like that's completely ruled out, but it seems like that would be the case. Okay, let's go over to breadth real quick. Looking at the market breadth, we did get that crossover today, where the market breadth crossed under the 10 EMA. So I'm telling you, I'm really anxious on the market right now. Yes, we're hitting all-time highs, but on very low volume, lower than a holiday week's volume. Market breadth has pulled back. I think we're right for a pullback at any moment. I don't know when it's going to be. I don't know how much it's going to be, but I'm certainly not not risking any money in this market. So let's transition over to New Trader, Rich Trader. We're in chapter 16 already, if you can believe that. If you haven't been following along, go grab your copy of this on Amazon. It's going to cost you like $8. Definitely one of the best $8 you'll ever spend. One of my top 5 trading books of all time. And these highlights, these notes in here are from the first time I read this. I don't know when it was, ages ago on Kindle, and it just happened to stick. So I think this is pretty cool. New traders follow their emotions, which put them at a disadvantage. Rich traders follow systems that give them an advantage. Now, I want to talk about a story Peter and I were chatting about on Discord. And he mentioned he could really see some improvements in his trades because he was making decisions based on his P&L. And just yesterday and the day before, I've been mentioning how much of a big deal it is to turn off your P&L. That's something Steve told me ages ago. He's like, turn off your P&L. Doesn't matter. Focus on your entry and exit signals and don't do anything unless you get an entry or an exit signal. And so I had mentioned that, and Peter relayed to me yesterday that he did that, and his trading has improved tremendously already. Right? There's a psychological aspect, an emotional aspect to seeing the dollars on the screen, right? Because I forget what it was, but it's like Mark mentioned it this morning in a meeting we were having. What do you call that? Some sort of fallacy. Either way, but it's like you win $100 and it feels like, hey, I won $100. You lose $100 and it feels like you lost $200, right? It's because the losses hurt more than the wins, and we are much more likely to take those small wins off the table and let our bigger losses run, hoping that they'll come back. But if you just focus on your signals, then it's just all noise, right? Because you're only waiting for those signals to move. All right, he new trader created a list for characteristics he was looking for. Stocks were within 5% of their all-time highs, over 5 million average daily shares. They all had new products or business models. Each had earnings increases or sales increases. And all the companies were expected to grow in sales and profits. So basically, strong companies. This is it. This is what I've been waiting for. All the stocks were in established uptrends with prices all above key moving averages like the 10, 20, and 50 day. I told you this is the book where I got specifically the 10, 20, 50 rule that I use. There it is. I've been waiting for that. That's actually been what I was most excited to come across. Right there, the 10, 20, 50 day. None of the stocks had lost their 50 day over the last 6 weeks. Typically stayed above the 20 day, touching only a minor retracements. Stocks spent 80% of their time above the 10 day, going to new high prices right around the last 2 earnings announcements. He set up some Bollinger Bands, which I don't use. You notice that many of the stocks in downtrends bounced off the Bollinger Bands. On those charts, the 10 day was below the 20 day, which was also below the 50 day. The stocks that had really crashed were also below their 200 day. There it is. Finally, I came across the 10, 20, 50 rule. I knew it was in here. So let's jump into these charts real quick. I don't know if I can zoom in. All right. It says he studied stocks and uptrends, right? So you've got, this is Amazon 2017, right? Moving up. You've got Facebook moving up. You can see how the moving averages are all stacked. And then you see something like this, like Google, right? That's an outlier move that we're looking for every day, where you've got your moving averages that are all crossed over and then kapow, moving higher. And then you've got Apple right here in this trend. And you study charts and downtrends, right? You got the 10, 20, 50 pointing down. I mean, when I learned that 10, 20, 50 rule, it's like so easy. Which direction are the stocks going? Up or down? Well, just look at the 10, 20, 50. Makes it easy. And then this one, and you can see here the longer term and the shorter term looks like the 50 and the 200 and how they crossed. You got Groupon. Right, beautiful uptrend, but those uptrends don't last forever. And that's why I say if your 10 moving average breaks, that's your let me get my cheat sheet real quick. Your 10 moving average is the strong momentum, no, indicator of the short-term trend. If your 10 breaks, then your short-term trend is down. And, you know, then you add in the longer terms. All right, let's get back out of that. New trader only wanted to trade stocks that had charts with solid, stable uptrends in price, and he decided it would be too stressful to trade stocks that had large daily price swings. Stocks with big ATRs, large daily price swings, you can quantify these numbers, right? And maybe you say like, oh, I don't want to trade anything with the ATR over 5, right? If that works for you, then trade around that. Or you can adjust your position size, right? The bigger the ATR value is, the smaller position size you should take because the bigger those swings are. Volatility was not going to be his friend in a trend trading system. He knew it would cause false stop losses to be triggered when a stock briefly broke below support, and early profit taking when the price would momentarily reverse below a trailing stop. A volatile stock could lose its 10-day moving average one day and be back over it the next day. You see it all the time. Saw an opportunity to buy stocks in his watch list at the 10-day moving average when it was breached and didn't recover before the close. Meaning, right, when it closes over, essentially is what he's trying to say. Hey, Michael. So he's saying when it crossed over the 10 and closed there, that's when he would buy. He would buy stocks on his watch list as they trade up through the 10 EMA or bounce off as support. After he made the buy, he would set a stop loss 5% below his purchase, and he would only risk 1% of his trading account with a 20% position size and his total trading capital. So this is something we need to, or we've tried to break down in the past, right? He's using 20% of his account. So round numbers, let's say at $10,000, he's using $2,000 on this one trade. But because he has a 5% stop loss on the trade, then he's only risking 1% of his account. I did the math correctly on that. So let's do some math on that. All right, let's say that we had our $10,000 account and we're using 20% of it, right? And let's say that it was a $100 stock. So we're giving it till 95. So equals $2,000 divided by $100 per share, $20, right? 20 shares. So if it goes from 100 to 95, that's a $5 loss times 20 shares. 100 minus 95 times 20 is $100. Look at that. That's 1% of his 10,000. The math checks out. So you can trade big position sizes. Absolutely. But the bigger you size, the smaller amount you should risk on that particular stock, right? So in this case, he's talking 5% pullback. I mean, you could do 3% pullback, right? You're basically making the... I heard somebody say it like this one time. They're saying, you're paying this amount to find out if it's going to work. In this case, he's paying $100 to see if it's going to work. If it doesn't work, then he's just out $100, right? It's kind of like buying a scratch-off lottery ticket, I guess you could say. He just bought a $100 scratch-off lottery ticket, and he's looking at it, and he said, you know what? I'm willing to invest $100 into this, and if it works, cool. If it doesn't work, that's fine too, because I knew the risk ahead of time. But if it does work, maybe he can make back the 100 or more. Once his buy was correct and his stock started trending 5% above the 10-day moving average, he'd set a stop at the current 10-day moving average, moving it up or down as needed. The popular moving average would be his trailing stop to lock in profits. This system was based on taking profits when the uptrend ended. It played it safe, getting out before any large losses could accrue after the loss of key support levels. To limit risk, it would be important to keep his position size at 20% of his account. The stop loss is at the 10-day moving average. He would only trade the system when the S&P was above. So he'd only trade the system when the S&P was above the 10-day moving average and the 20-day moving average, and the price. I'm sorry, I did it wrong. When the S&P had the 10-day moving average over the 20-day moving average and price of the S&P above the 50-day moving average. There it is. The market needed to be in an overall uptrend and bullish for his system to be consistently profitable. He believed this rule would increase his odds substantially. Randy, 5% is a bit too tight for me. It was getting stopped out too often, and then the stock would take off. Dude, yeah. We've all been there, right? And that's one of the reasons why I modified my exit rules specifically on that topic. For the close below the prior day's low after I've already rolled it, right? Because you can get into a situation where the stock's just like barely moving here or there, or maybe it even closes down a little bit, not even all that much, but it's below the prior day's low. And then it turns around and goes without you, right? I ran into that plenty of times. So that's why my one and only stop loss is now the half ATR from entry. Which, you know what, Randy, that may be too tight for you even. I don't know. Don't trade someone else's system. And this is why I always say, this is how my style of trading, you need to build your own. Customize it to fit the principles you've studied and those that you believe in. Your system must match your own risk tolerance and return expectations. Be wary of straying from your trading plan because a mistake that wipes out your profits can impede your ability to trade going forward and take a toll on your confidence. Don't let fear and greed make you do something destructive. Always stick to your plan. Quint Tatro, quote, the sooner you realize you're trading against other traders and not just the stocks or the market, the better off you'll be. So, yeah, great lesson today. Basically, 10, 20, 50. So good to see it in black and white. I knew it was in here somewhere. But of course, you've got to follow your own system. Figure out what is working for you. Because my style, while it works for me, may not work for someone else. And I'll be the first to say that it may not, right? Mike asks, any platforms that automate your trades? Well, Outlier will be doing that here in a minute. Outlier is planning, one of the roadmap things we're working on for first quarter is for automations. And it's going to have broker integrations as well. It's going to be really cool. Then we're also going to be building a stock trading, what is the word I'm thinking of? A strategy library. So this was something that I'm going to be mentioning in the Discord in the next few days, but we want to get your strategies, right? We want to know how you are using Outlier, other ways that you want to trade, right? Maybe like we were talking about in New Trader, Rich Trader, on a pullback to the 10 and then a close back over the 10, maybe that's your entry signal, right? Or maybe a bounce off the 20, something like that. We want to know what strategies you're trading on. And then, we're going to backtest them, make sure that they are profitable strategies. Because if they're not, then we don't want to be having people automate them. But if they are, we do plan to have automations in the near future to make all of your dreams come true. I'm super stoked about that. That's going to be really, really awesome. Sweet. I trust Outlier. Brian, thank you, dude. Peter says, excited to hear. Yeah, automations are going to be a huge deal coming forward. Because, I was talking to Mahesh and Mark, and I was like, listen, guys, when someone comes here and sees this, right, the customer objective here is to have more money in your account than he did yesterday, right? We can all agree to that. That's what I want. That's what you want, right? More money in your account than yesterday. But logging in and seeing this is very daunting. I will say that up front. It's very daunting. Like, what does all this mean? In fact, earlier today, I was relaying how to Mark and Mahesh. I was like, listen, if somebody new came on to Outlier today, it'd be just like the first time I saw an options chain, seeing all these numbers on the screen and saying, I don't know what all these numbers mean. I just want to make money, right? And right now we have all these charts, all this data, and we want to make it as easy for you to use that data to make money. So we are actively working on how to make Outlier easier. That's where I'm going with that. Can we get Mahesh and your physical address in case the auto trading doesn't work? Why do you want my physical address? That's kind of weird. How about I meet you in Atlanta, Brian, after the auto trading works out, and we can go out to a nice steak dinner together. So speaking of, thank you all so much for coming to today's trading room. Let me go to my screen over here. We couldn't do this without you. We want to pay you back every single day by helping you save time, make money, and start winning with less risk together as a team. Let us know if you need anything over in the Discord, and tell everybody you can about it by hitting the like button. That really does a lot for us and helps us get out to more people. Have a fantastic afternoon. See you right back here tomorrow, and we'll talk soon.